Hello everyone, this is Brian Adams. I see some more people coming into the call. Just wanted to make sure everybody can hear me so far. So on the screen you should have a question box. Can someone just quickly put in the question box or chat field that you can hear me okay? Perfect. Thank you, Philip. Appreciate that. I'm just gonna give just 2 more minutes and we will get cruising through this. The call will be set up in a structure where I'll go through just a little bit of some training info. And then any questions that you have as we go along, you can put those questions into the chat field. And I'd love to get as many of them answered as possible. And this is just a time for you to, ask away and see what I can do to help you move your wealth creation business forward. Either that being single family houses or multifamily, doing wholesale deals, etc. So this is kind of a time for us to work together and see what we can do to kind of help you move your business forward. So again, I'll just wait a couple more minutes until some other people are logging in and getting their I guess their systems all set up. Right, got a couple more people. I just got a couple text messages, so I'm gonna give just 1 more minute, and then we're gonna get cruising here. All right. Well, I think enough people are already in, so I'm gonna get going. I call this presentation "Secure Your Financial Future: How Real Estate Can Create Wealth." Just want to set this call up that this is a free training. I'm not selling anything, but the one disclaimer would be at the end, I will give you an opportunity to look at something, but this is a time for you to ask any questions that you have about investing in particular multifamily. So just real quickly, I'm Brian Adams. I'm a managing partner of Adams Investor Group. I buy single family houses and multifamily apartments. My background is I'm a CPA with a real estate taxation focus and forensic accounting experience. And I got started in real estate many years ago. I guess it's been 12 or 13 years, but it actually goes even further back. When I was really young, I used to help my grandfather. He used to have several rental properties. I'd tag along with him to help collect rent, just kind of being around. I'd mow his lawn, I'd pick up the trash and earn, a couple bucks. But I always got to see the power of wealth creation at a very early age. Tenants are paying your mortgage and your expenses, and you're putting whatever's left over after paying the bills, kind of some cash flows. But I didn't immediately kind of pursue real estate. I was a junior in high school, and my accounting teacher was my high school football coach. And he pulled me aside one day and said, "Brian, you're the not the fastest guy on the team, but you've got something here with this accounting. You've got a knack for numbers, and I think you should pursue that. You should be an accountant later in life." And most kids in junior in high school were probably not thinking being an accountant, but more like a lawyer, a doctor, a movie star, whatever. But for whatever reason, I decided to go into accounting with a CPA background and also play college football. So I was middle linebacker there, number 92. But what I do is I create wealth so that my investors make profits, and I use real estate as the chosen investment vehicle. So I acquire multifamily assets such as apartments and single family houses, and I target these properties across the country to maximize profit potential for my investors. And some of this, I'm going to zip through it because most of everyone on the call are real estate and background. So you've got many choices with wealth creation, and that could be cash, commodities, stocks, bonds, collectibles, in particular, real estate. And I think we're all, living, we're like-minded in that, the billionaires, 129 billionaires worldwide have created their wealth through real estate. So I think we're in great company. This looks familiar to me when I go to the bank. Banks are paying less than 1%. And with real estate, there is an opportunity where you can leverage other people's money, get into transactions and use other people's money and provide them a good return on their money. And you can do this all without using your own funds. And I use that slide as just representation to an investor that you can do better on your money versus having it parked in the bank earning less than 1% and purchasing power is being eroded by inflation, eating that purchase power. Why real estate in general? Well, I think you guys already know this. There's many segments of real estate: industrial, office, storage, retail. In particular, we're going to talk about apartments today. And real estate is faster appreciation, and the investment can be secured by the collateral or the property. Real estate provides a basic need. It's fulfilling the needs of basic human necessity. And I speak specifically about real estate of single family houses as well as apartment complexes. And there's always going to be demand for real estate because a place to live is a commodity. And what I'm finding in my research, and I know this slide is a little bit dated, it goes back to 2011, but the American dream of owning a home is fading fast because of where our economy is currently. Individuals need the flexibility of an apartment complex so that they can, if they have a job across the country, they can, pick up and leave and not be tied to a house or anything with a mortgage. Investing in single family homes. Imagine if you've got these 20 different properties spread around your particular city and you're renting these out. So that's 20 different tenants you have to deal with to go collect rent, 20 different lawns to mow, 20 different roofs to maintain, which can be a real pain in the butt. Which you compare that to a 20-unit apartment complex where you've got all your tenants under one roof. I think of the economies of scale where you've got a management company in place to deal with your tenants where you're not dealing with those calls 2 in the morning. You got the management company in place to handle all that. And also, if you've got this 20-unit deal and you have one tenant leave, well, you've got 19 other tenants paying your mortgage and expenses. Versus if you've got these single family houses and one person leaves, you're out of pocket on those mortgage and expenses. So that's why I really like the apartment buildings, and also why apartments versus single family homes is that apartments, as I shared, they're easier to manage. You can have economies of scale. You can have all your tenants again under one roof. You've got a greater profit potential and ease of financing. Generally speaking, when you're financing an apartment complex, a lender is generally going to look at the property versus you particular. Now, they will look at your experience, your credibility, your net worth, your liquidity, but generally speaking, the way the apartment building is performing from a cash flow perspective, they'll look closer at that apartment complex. Before I go further on, I just want to make sure everybody can hear me again. I know some new folks came in, maybe Marcel. Can you just type in the chat box that you can hear me okay? I'm not getting anybody. I don't know if maybe anybody else, can you just type in there quickly? Oh, perfect. Thank you. I think it's Verna. Thank you so much. Appreciate that. All right, then we're going to keep cruising because I want to get to make sure there's enough time for you to ask questions. So for those who maybe have joined late, this is going to be just a Q&A call. I'm going to present some information about apartments, and this is an opportunity for you to ask any questions and see if what answers I can provide to you. And if I can't get an answer to you right now, I'll definitely seek you out and get whatever information answered for you. So why apartments now? We've got an increasing demand. The economic downturn has put home ownership out of reach for many consumers. Our U.S. population growth is expected to exceed 60 million. Again, coming back to that commodity, real estate is a commodity. Everybody's going to need a place to live. New construction, as you may know, when we hit that recession bump, 2008, the construction starts significantly, plunged. We're starting to see In certain markets that I target, their building is booming again. So I'll touch on risks of apartment here in a second, but we are rebounding in certain marketplaces with construction starts going again, and the vacancies down, and that means rents are going up with lower mortgage rates. Shorter lease terms allows faster rent increase, and that hedges against inflation. And with apartment complexes versus single-family houses, you can have other revenue streams such as storage, parking, laundry income, all kinds of different other revenue streams that can come in. More foreclosed and bank-owned properties are available, and you've got motivated sellers. So there are deals out there that your sellers are still upside down, and you can get some really good opportunities on. And income producing apartments buildings can be bought at deep discounts. And most important, cash is king. If you've got the cash to close a deal, and that's when you make your biggest opportunity. As you know, if you're whatever segment of real estate you're in, if you're doing single family houses, if you got an all cash offer, you can really get some good discounts. What's driving demand for apartments? Echo boomers. Echo boomers are the babies of the baby boomers, and their age is in between that 20 to 34-year-old. They're maybe out of college. They realize that the job market is not the best. They don't want to be tied to a house where they've got a mortgage, and they need to be able to move quick to maybe a job that's across the country. So that's really driving demand for apartment complexes, is what we call the echo boomers. Distress equals opportunity. There's several ways to get a property that's going to be in distress. As you probably know, market conditions, poor economy. The sellers, they're forced to sell due to over leveraging or property distress, low occupancy, below market rents, and increasing deferred maintenance. The risks for apartments, well, just like any investment, there are risks. Overbuilding of apartment units, as I mentioned about construction, we are seeing construction picking up. Single family housing picks up. There's also, with single family houses, you've got certain markets are rebounding on a quicker pace than others. Rent increases outpace rate of income growth. Employees' wages might be stagnant or going down versus the rent increases keep going up, so that might outpace growth potential. Unemployment can kick in, financing concerns. This is a concept that I cover when I look at multifamily deals, or most any other opportunities really, is I break it into four components, and I call it my 4D approach. It's the deals. Where are we going to go find these opportunities? How are we going to source them? The due diligence that's involved, and the contracts that maybe that need to be in place to take down an apartment complex. The other component is the dollars. Where are we going to get the funds to close? Are we going to leverage that with debt, or is it going to be completely 100% equity? And then dealing with the investors, making sure that the investors are keep in the loop and made aware of kind of the opportunity, the good, bad, and the ugly of the deal. And then the next part is the direct. You're going to close the deal, and then how are you going to manage that deal? Are you going to do self-management or leverage that as to a third party? And the best part of the transaction is the done. How are you going to get paid? Again, I'm going to quickly go through some of this information as we're going along here. If you've got questions, make sure you get that in the chat box, and I want to answer any and all questions for you so you can be successful. So the deals. I always get this question, so I put this in here. Where to locate deals? Well, I locate my deals for multifamily product using real estate brokers. That ranges from the big brokerage houses like Marcus and Millichap, CBRE, ARA are some big ones, as well as second tier brokerage houses. You want to develop relationships, just like in any business. You've got relationships with investors, as well as you want to create relationships with real estate brokers, relationships with banks. Securing REO product directly from a banker. You can find these deals online sources such as LoopNet.com. I will, for a disclaimer, I've never bought a property on LoopNet personally, but it's definitely, there's properties out there that you can go to evaluate and create or establish relationships with brokers. I do direct mail, so I send letters out to absentee owners, burned out landlords, or retiring landlords. That's a good strategy. and you may come across these owners that are trading up. Maybe they bought a 30 unit deal and they want to increase their portfolio. So they may do what's called a 1031. That's a tax term where they do a like kind exchange to defer their taxes. Dealing with other real estate advisors, and I find a lot of deals with other investors, like wholesalers. They go out and find these deals, and they may not have the skill set, nor are they interested in buying apartments for the wealth creation or the cash flow. So they bring me deals. So as you're establishing your real estate business, you want to have as many funnels, marketing funnels going as possible. And that might be dealing directly with brokers, banks, online sources, etc. Property and location type for multifamily. So think of this as a grading scale. We're going to go through A through D. So your A grade is the luxury apartments, modern amenities, good location. Normally they're going to be the low returns unless you buy it right. It's the property is maybe 10 to 15 years, and that's what an A property looks like. Nice and clean and looking good. Then a B product is it's going to be a tenant mix of white and blue collar workers. Okay location, buildings, 20 years, maybe 30 years. It's good buy for cash flow and appreciation, and that's what a B property would look like. And then the next would be a C. It's a tenant mix of mostly blue collar workers. Section 8, buildings about 30 to 40 years old. It's a good buy for cash flow, and that's what a C class asset would look like. And this is an area that I don't really target, but you can make a lot of money in the D, which is the war zone, high crime, and good buy if you own a what I call an AK-47, and that's kind of I stay away from that product. But I did want to set the scope for you that the property and location is on a grading scale from an A product to a D product. Types of deals from a buying strategy, you've got a momentum play, which is high occupancy, no deferred maintenance, it's well managed, consistent cash flow with nice profit. A value add deal is occupancy is lower than market, little deferred maintenance, rents lower than market with cash flow, rent growth and new income sources with big profits. Where you can make a lot of money, but there's a lot more risk, is what's called a repositioning deal. So you might have an asset that has high vacancy with significant deferred maintenance, maybe poor management, or there's no cash flow currently, but in this particular market, if you were maybe the owner and you had the right team in place, you could take a property that's 50% occupied with doing the deferred maintenance, increase rents, and then get the property to 80%, and you can make a lot of money doing reposition deals. So here are just some terms if you're not familiar with them. So NOI, net operating income. This is the income the property generates after expenses are paid, excluding the mortgage payment. So NOI equals total income minus total expenses. Cap rate is expressed as a percentage to reflect the value of income producing property. The lower the cap rate, the higher the value. So it's an inverse relationship. The riskier the returns, the higher the cap rate. The low risk class A deals are going to be a low cap rate. And where I'm at, a 4 cap or 4.5 cap, maybe a 5 cap is normal for a class A deal. Debt coverage ratio, that's the most important part a lender will look at. Generally, that's the lenders want to see a 1.25 cover. So this means that it's the ratio of how many times your net operating income will cover the mortgage payment. Again, if I'm going too fast or going just right, just go ahead and put your questions in so that we can tackle the questions at the end. All right, so value play. One of the most important parts when I'm doing deals is I love value play, and that creates appreciation. So there's ways to increase value of a property by increasing rents, decrease the expenses, increase occupancy, fix deferred maintenance. So really what you're doing is you're solving a problem and you're forcing appreciation. So I want to show you an example of how a value play would work with increasing rents. So let's say you've got a 200 unit apartment complex with an NOI net operating income of 400K per year, and you know that the market cap rate is in this particular area is 10%. Your next question might be, Brian, well, how do you determine this cap rate? Normally what you can do is talk to real estate agents or brokers, appraisers, management companies to kind of get a sense on what I call trading, what's trading in the marketplace, and what is the market cap rate. So for this example, and these numbers obviously are made up, so In this example, I'm going to use what's called a 10 cap for my selling price. So we know, this is just some basic math, that the value of this property is $4.4 million. And how do we know that? Well, we know our NOI is 400K. We know what this property market, from a market perspective, is going to trade at, and that's just 400K divided by the cap rate is 4 million. So let's assume our extensive market data reveals that we can increase our rents by $25 a month. So if you look at the example, $25 per unit times 200 units times 12 months, that's 60,000 of additional NOI. So our new NOI is now 460. So it's the 400K that we started with plus the 60. And so look how we've created value of 600K of equity is created just by a very simplistic model of increasing rents. Some disclaimers would be you can't all at once, increase rents by $25 a door. You do have to adhere to the leases that are maybe in place with the current tenant profile. And you also got to be careful that these $25, either it might be considered a nuisance rent increase, but you got to be factoring in vacancies. Some people will be upset about them having to pay $25 more, so you do have to account for the decrease in rents, or I'm sorry, your occupancy over time. People might get upset and leave. Excuse me, the dollars. So how are you going to fund your deal? Well, you can use leverage, of course, using a mortgage. You can use your personal cash, or you can maybe go out and find a line of credit. You can use hard money lenders. Where I play is I use investors, particular private offerings to investors. You may know what a public offering like an IPO, or I guess a stock that's traded on the stock exchange. So I present these opportunities to investors using private offerings, and I structure my deals as either a debt arrangement or an equity arrangement. You may know this, but a debt deal is an investor is getting a stated return on their money, versus an equity deal. The investor is sharing in the upside of the deal, the cash flow, as well as the tax benefits such as depreciation. So each deal, or each structure, I should say, has merit, and it just really depends on how you're structuring your deals to be the most successful. I found that the equity deals are the fastest and quickest way to get money, private money into your business, because most investors want to share in that upside with you, but the risk is they also share in the downside. So if the deal doesn't go as planned, they also are sharing on the downside. So dollars needed to close a multifamily deal. These are general, but pretty consistent, I guess. You'll probably need, when you put an offer in on a property, you'll need, excuse me, earnest money of about 1% of the purchase price. You're going to need a down payment of 20 to 30%. You'll have costs for an attorney, third-party reports, due diligence, closing costs. You'll have monies set aside for taxes and insurance. Lenders most likely will want you to put monies aside for capital expenditures. And I charge this acquisition fee for all my deals. It's 3 to 5%. That is a fee that my investors pay for all my hard work of putting these deals together. So just make sure, if you're going to structure your deals that way, to make sure you're raising enough money for the opportunity. So directing the deal. You can set up your structure as a partnership. You can set it up as a TIC, a tenants in common. I prefer partnerships, but there is some advantages of a TIC, but I personally would advise you to do some serious research into TICs, and maybe advise you to kind of stay away from them. But so then when you actually own the property, you need to determine how you're going to manage it. Are you going to do self-management, or are you going to hire a management company to do that, or are you going to be an asset manager? And that's kind of where I'm at. I'm an asset manager, so I'm overseeing the property management company, and I'm also overseeing the asset for my investors. So I'm communicating to the investors, again, that good, bad, and ugly, and I'm making sure that my management company is performing, and our budgets are being adhered to, and profits and cash flows are being made for the investor. Directing the deal, you always have that challenge of balancing your time versus your money and your network and your passion. So you definitely want to determine is if your involvement of acquiring a multifamily deal, are you looking to be an active investor, going out and finding the property, doing the due diligence, negotiating the contracts, dealing with third party individuals, dealing with the lender, dealing with the day-to-day stuff, versus being a passive investor. Just you've maybe got the money, but not the time, and you just want to earn a return on your money and being more of a passive investor, not involved in the day-to-day stuff. What can go wrong? Well, everything in any deal can go wrong. Your tenants don't pay your rent. The property can't be leased. There's change in interest rates. There's not enough cash flow to pay the expenses. You've got poor management, external factors such as environmental, economic, political. All investments have an element of risk, and as you know that, so I'm not going to hover on that too much. The done part. So how are you going to get paid? Well, as what I call a sponsor or an operator, that's the person putting the deal together, and then you may need to go out and find investors that will share in the maybe as an equity investor, they're going to share in cash flows and things like that. But how the deal gets paid out is most deals that I do anyway are cash flow driven. So you've got opportunities that those cash flows are going to be paid out either on a maybe a quarterly basis or semi-annual basis, depending on that opportunity. You'll have appreciation. Maybe you're buying a deal for X and you're going to do these value plays. So a couple years down the road, the property is going to be worth Y. You'll have tax depreciation that's going to help you from a tax perspective. You'll have equity buildup, so your tenants are paying down your mortgage, and then you'll have long-term capital gains rates. So you might be able to leverage different tax rates to help you save, pay Uncle Sam. And then you can use some creative wealth creation strategies that I love are a 1031. Again, I mentioned that earlier, doing a like kind exchange, or you can invest a self-directed IRA into multifamily deals, or your investors can do that, and that money or wealth, compounds over many years, and there can be a significant savings or significant wealth creation tool. Here's just a couple deals I did, and then we're getting ready to open up for questions. So hopefully everybody's prepared for that. Deal I did in 2010. It was a 270 plus unit deal. It was a bank-owned product. We got it for 4.5 million. It appraised for 12 million. The property was over 90% on closing. This was a C-class building located in a B area. It's highly desirable part of town, and this just shows that the appraisal was 12 million. Some people ask why I sold this deal. There was a large investor that wanted this opportunity all to himself. So we did a bank refinance. He retained the asset or the property and cashed myself out as well as my investors out of the deal. And I wasn't too upset about that, and I'll tell you why. In 2010 in Nashville, Tennessee, there was a flood, and most of the competition where this property was sitting was impacted by the flood. So these tenants were displaced and needed a place to live. The market occupancy was the high 80s, where we took this property over in 94, 95%. So I knew once the properties were the properties our competition were rehabbed and fixed, our occupancy would drop. So I was fine with exiting this deal and getting kind of paid out. Then in May of this year, I bought a 144, I'm sorry, yeah, 144 unit deal in South Carolina. It was a Class A product, 10.3 million, and we did a 40-year mortgage. It's amortized over 40 years at a rate of 4.15%. It's an interest rate, and that loan is assumable. And this loan product was a HUD loan. It's called a 223A7 loan. As you can see, the terms are great, but dealing with HUD or a government agency can and is a pain in the butt to deal with. So as you are putting your deals together and with a lender, just be cautious that you need a patient seller because a HUD loan does take more time than a traditional Fannie mortgage or generally speaking, any other loan. A HUD loan is going to take a while. Here's a deal I just bought, I guess last week, I guess. It's a 200 unit C-class deal in the C area. I bought it for 6 million. It's right around 90%, 91%. And this is a true value add opportunity. Rents haven't been increased. I do direct mail and I send a letter directly to the owner. to acquire this property. He's just turned 80 years old. He's self-managed this for 20 years, and it's been kind of his day-to-day, job that to be involved with this property. So I've got I've kept the seller in place to help me take over the product because he didn't want to go cold turkey, meaning he's been doing this for so long, he just didn't want to sell it and be done. He wanted to kind of transition out over a period of time, which helped me out because I didn't need to bring all my equity at one time. Over the next 6 months, I'm paying down the equity that I need to pay him using the cash flows of the property. I also do single family houses. This is just a couple deals I'll show you, and then we're going to get to the Q&A side. But I buy some houses here in the Philadelphia area. I do about 1 to 2 a month. I bought this house for 42.5, sold it for 139. I went to an investor who put up 100% of the purchase price, rehab and closing costs, and that was 86. So that the investor got paid the 86 plus a return, and whatever was left over was my profit. And so summary. Hope this was helpful so far. Um, the finding the deal, the funding the deal, manage the deal, and getting the paid, which I think that's all what we're striving for is the paid. I will tell you that owning and managing multifamily properties, they're more work than probably what some of the experts make them out to be, but it's all relative, and you can leverage other folks' skill sets to help you get your deals across the finish line and making some serious cash flows, passive cash flows. I wanted just to mention this. You may have seen this in the Living the Dream Facebook, and that's how you and I got connected. But I have a goal to help veterans get into home ownership. Last Thanksgiving, I'm in Pennsylvania, by the way, not too far from Wilmington, Delaware. So I guess last Thanksgiving, I attempted to feed 1,000 homeless veterans. We only fed about 250 individuals, but we made a significant impact to the community. And this past January, I secured a 29-bed facility in Center City, Philadelphia, to get veterans off the street. Unfortunately, that that arrangement didn't work out so well, so that facility is no longer in place. But if I could, I'm gonna hopefully put this maybe in the chat box for you to, if I could trouble you to go vote for me. This particular company is called GKIC. They're giving away $10,000 to help an entrepreneur such as myself to create, a product or a program or whatever else. Right now, I've got 7 votes, so I'm trying to, and I think the winner right now or the leader is about 112 votes, and I think the voting shuts down December 9th, I believe. So all you need to do if this is of interest to you is I just put the link in the chat field, but I think you need to click the Facebook link, you need to like the page, and then kind of vote for me if that would be kind of all right with you. Um, I'm hearing when I provide this link that Facebook or this GKIC is asking you to access your personal contacts and your address book and all this other goofy stuff. So if that happens to you, could you just maybe send me a private message? Because I don't know why some people are getting this thing and I'm not personally. But anyway, if I'll leave it there. If you could maybe consider voting for me, I would appreciate it, and share it with your friends would be awesome. Let's see here. All right, so I'm getting ready to open up to any questions. And again, guys, this is your time to, ask away if there's anything I can do for you to drive your business forward. Um, we'll go from there. But I did in the first part of the call, I told you that this would be a free training call without any sales at the end, and the only disclaimer would be here at the end. I've raised private money for my deals, and until I really discovered the power of private money, I was really struggling. I was using hard money, and I was about a week and a half from doing a deal with a hard money lender, and I got burned. The hard money lender, for whatever reason, decided not to do the deal at the end, and really kind of put me in that bad situation because I had to go to the real estate agent and say no, I can't buy the property now because I don't have the money. So I really took it upon myself to go out and develop a strategy for myself of what I call how to locate and secure private money from investors. I really built this guide for myself, but as my business exploded, I think I'm up about 1,200% of just using private money to fund my single family houses. I leverage, the apartment complexes with debt. Then I go out and use private money for putting these deals together. So I'm never out of pocket myself. I created this strategy, and then other investors came to me and wanted to know how I was doing it. So I wrote this ebook. I will tell you it's not the best quality, meaning it's not going to be a literature masterpiece by any means, but it is really a kind of what I think of as an A to Z type of approach to raising private money. And I'm not going to harp on it too much. So if you're interested in securing this resource, it's generally going, I think, $30, and I'm giving a 50% discount to anybody on the call here. So if you want, you can secure that. The discount code is, I think, LTD, or right now I think I made it that everybody gets it at $15 off. So with that being said, here's my contact information. You're probably gonna we're gonna be wrapping up here soon. I don't see too many questions in the queue right now, but if there's anything down the road, I can assist you with. Excuse me, or give you some, pardon me, or give you some guidance. I'm here for you. So I've got a question here from Jake. How did you find those out-of-state properties using mails? Let me just grab a drink of water here. So Jake, for that deal in Dallas, I bought a list from a list broker. I'm not sure if you're familiar what a list broker is, but a list broker is someone who basically collects data, and you tell that list broker what you're looking for, such as, I target 100 to 400 unit apartment complexes, purchase price less than $15 million, located in this particular zip code, and you put all these metrics out there, and then these list brokers go out and scrub or go look through their sources to find these owners of apartment buildings. So then I send out direct mail pieces to them. Hopefully that was helpful to you. All right, so Verna, can you go over the numbers again? Um, can you help me out just a little bit? What you mean by can I go over the numbers again? I just want to make sure I get your question answered. And what numbers you're referring to. Um, so Marcel is asking, what are you saying with your direct mail? What am I saying with your direct mail? Hmm. I am not sure on that one either. So if you can give me just a clarification, I would appreciate it. Darnell is asking, how long does it take to buy an apartment complex? It depends. If you have a normal lender, not HUD related, it could take maybe 90 days. So that's a 30-day, what we call a due diligence period, where you get that property under contract, and then you have 30 days to look over the financial numbers, the physical, and then you might have another 30 days to go get your financing, and then you may close 15 days after that to once you get your loan commitment. And I use 90 just to be safe. A HUD deal may take you 10 months. It took me about 11 months to do the HUD deal. And what I did there, I'm sorry, I didn't say that. The 144 unit deal was I assumed a HUD loan, so that took 11 months, and then I refinanced that HUD mortgage, which took about 6 months. We bought it in May. We refinanced that in October. So the HUD does take a while for that to kind of happen. Oh, okay, Verna, thank you. I'm just gonna hop back some slides, guys. Sorry about that. So Verna is asking about forced equity on apartments. So I'm just gonna put that slide up again. Hopefully this is kind of what you're referring to, and this was in the value play. Okay, so again, here are the numbers again. We've got a 200 unit apartment complex. The NOI is 400K. We've got, because of the metrics, as I already talked about, we know the market cap rate is a 10 cap, so we know the value of the property is 4 million. So we come in and the market data reveals that we can increase our rents by 25 bucks a month. So 25 units, I'm sorry, 25 per unit times 200 units times 12 is 60,000 of additional net operating income. So now the new NOI is 460K. So then That value, again, it's taking the NOI divided by our cap rate. So the new value is 4.6 million. So we, in essence, have created 600,000 of equity. So I hope that is, Verna, what you're looking for. And Marcel, okay. So what verbiage is included in your direct mail piece? Is on my phone, so I have it. Oh, no problem, Marcel. So I, kind of make it in my direct mail piece a strong call to action. I want a nice headline like, why is that particular owner wanting to sell? And I try to think in the eyes of that owner. And this 209 unit deal I bought in Dallas, that letter went to an owner who had, have owned the property for a while. So they had, equity in the deal, and also someone that was self-managed. So again, using a list broker, we were able to kind of drill down to what that individual is, and so I use, I guess Marcelo also is we use different what I say a call to action. Why would that owner want to speak with me? If maybe it's he's burned out or he's tired of getting those calls at 2 in the morning because he's been self-managing that property for a while. So you just want to hit those buzzwords or those pain points and see what solution you could provide. And ultimately, guys, you want, when you're doing any direct mail, you just want the seller to call you, and hopefully that's a qualified lead, and then you can qualify them with, depending on where the property is located, if it fits into your investment criteria. Verna's asking, how would you know if it's self-managed? Sometimes it's crazy, but some of these investors, real estate owners, put the apartment complexes in their own name. Uh, so I wouldn't personally do that from a legal or a tax strategy, but that's how I can usually determine that it's a self-managed property. Not always right, but that gives me just a rule of thumb that if it's just Brian Adams, owns this property. Well, that to me means he's probably self-managing. That doesn't mean 100% though. It's just giving me just kind of some ideas about it. Olivia is asking, where do I find a good property manager? Great question. I buy properties across the country, and this is specific to apartment complexes. There's a good resource out there. It's called IREM.org, and that's like the Institutes of Real Estate Management Companies. IREM.org. If you Google it, um, you'll find it. And basically that's like just like a doctor here, has to get licensing. I myself as a CPA have to get particular licensing. As a manager, it's called a CPM, a certified property manager. That's kind of where you would go to find good property management companies. Another strategy I use is I ask my real estate brokers, title folks, hey, who's a good management company in this particular area? If it's a B product in a B area, over time when you develop these relationships with folks, you'll start hearing the same management company's name come up. So then you may know that you have someone at least to ask those questions to. Scott's asking, should I find the deal first or the money? Wonderful question, Scott. I say both, personally. There's some experts would say you go find a killer deal, the money will follow. But when you're on these 30-day due diligence periods, if you can get 45, that's great. But most brokers and sellers want to, sell their property because they want to get it done quick. So if you are, if you don't have your money lined up in advance, those 30 days, guys, goes very quick when you're doing a financial due diligence. You have inspectors coming in, doing your property inspections. You've got, termite and all these other surveys and inspections going. That 30-day due diligence goes very fast. And if you don't have your money raised, because you also need to be, raising private money for your deals, or unless you're doing a smaller deal where you can, come out of pocket yourself. So my suggestion is carve up your day or your week to focus on targeting opportunities at the same time targeting private money, because if you're raising private money for a $10 million deal, equity on that structure could be 2.5 to $3.5 million, and so you're not selling a $20 widget. So it's going to take an investor to a period of time to get comfortable with you, and so you need to really structure your private money business just like you would looking for deals. Philip's asking, Do you use any specific tools to analyze a deal? Um, I use an Excel schedule to that I formulated, just underwriting what I call underwriting the property. I put the income in, the rents, and do what I call underwriting of the property. There's programs out there or other software programs out there that you can use to help analyze deals. Marcel's asking, how are you finding the private money? What are you paying your investors on average for their money? So again, finding the private money is everywhere. I always get that question of I don't know anybody. Well, what I do is I target, first starting out, what I would suggest you do is sit down on a piece of paper and write out maybe 10 or 15 people that you know. Maybe it's family or your friends. Maybe it's a CPA, an attorney, or maybe it's your doctor. Just write their name, put it on a piece of paper, and then what I would want you to do is ask those individuals not for money, but tell them what you're trying to accomplish. Saying, "Hey, I want to buy an apartment complex, and I'm looking for potential investors. Do you happen to know anybody that I can help get a greater return on their money than what they can get at the banks or dealing with the volatility of the stock market?" Why I say it that way is because you don't want to ask immediately your friends and family for money, because immediately they're going to put up this wall, and it might be some weird, uncomfortable, conversation. But most likely, your friends and family is what I call in my ebook resource is your circle of influence. So your friends and family are most likely going to want to help you out. So if you go to them and say that you have a need or a challenge, then their minds are thinking to themselves, well, hey, who can I help? Marcel out on getting private money. Maybe there's a friend of mine that's, has come into some wealth and I can put these guys in contact. And then also what happens is that as you're educating your family and friends so that they can go tell their family and friends, you're basically creating your investors with your family and friends because, they want to learn about your business so they can, communicate to their friends and family exactly what you're looking for. At the same time, you're educating them. So what I've had in my experience is then these investors say, hey, this sounds all really cool. I've been giving you names and referrals, but how do I participate? Well, what have you done? You haven't asked that person, your family or friend, for money. You have let them get educated through just resources that you put together, and then you're growing your investor pool significantly. Your next question, Marcel, I hope that was quite helpful to you. Your next part of your question was, what are you paying your investors on average for their money? It really depends, and I hate to give you that answer, but it depends on the deal. If your deal can afford you, if you're going to make $1 million or 500,000 or whatever that is, and you can afford to pay your investor 15% or 20% on their money, I'd do that all day long. My um, my question back to you or statement back to you is if you start promoting deals at such a high interest rate, 15 to 20%, immediately I think bells and whistles go off on in people's heads that seems too good to be true. Think of Bernie Madoff. So I generally target, to say, 6 to 10% on their money, and that at least establishes conversation. And be real careful, guys. Again, I address this in my resource, but be very careful with the SEC that you don't want to, like, if I was on this call and I was pitching a deal to you, I wouldn't say, hey, I got this great opportunity, 100-unit deal, and you're going to make 10% on your money, and I don't have what's called a pre-existing relationship with you. The SEC could get you, you can get a lot of trouble by pitching a deal where you don't have a pre-existing relationship. So there's a whole strategy and structure behind raising private money. And again, I hope that was helpful to you. Um, which is Williams asking, what is better? Let's see. What? All right. What is better to get started with? A 24-unit deal or a 100-unit deal? I get that question quite a bit. And I would suggest, maybe go against the grain here a little bit, I would suggest, if you've never done a deal before, to start at a 100-unit deal. And the reason I say that is you're going to have, or you're going to experience, um, I'm just going to, I'm sorry I interrupted my thought here, I'm just going to put my contact information because I know I'm getting some messages that people need to drop off, and I want to be, respectful of your time today. So, in case, there you go. In case, down the road you need to get a hold of me, I just want to give you that resource. Anyway, back to William's question. and I'll go a little faster here because I'm getting prompted that people need to get going. What is better, a 24 unit deal or a 100 unit deal? As I said earlier, I would go target the 100 unit deal because you're going to go through the same steps of acquiring a 24 unit deal as you will with a 100 unit deal, meaning you need to get, most likely a commercial loan. You'll most likely need to get physical inspection, most likely need to get an environmental phase one, most likely need to do a survey. So you'll be running all these steps versus a 100 unit versus 24 unit deal, and your profit potential on a 100 unit deal versus a 24 unit deal will be significantly more if you target for bigger product or bigger properties. Downside, of course, is with a 100 unit deal versus 24 unit deal, you may need to require more equity. You'll need to have maybe some other key members of your team in place to help you. If you've never done a multifamily deal before, you'll need to have some members on your team to help you get that loan structured. So hopefully that was helpful to you, William. Stephanie, how much should I pay my investors? I think we covered that, Stephanie. If as I say it again, it really depends on your deal. If your deal can afford you to pay higher return and make sure that you get their money in, then lo and behold, do that. But it really just depends on the opportunity and the deal structure. Troy is asking, I don't know anyone with money. Where do I start? Again, I hope I already got that question answered for you. You have family and friends, I'm sure, that can kind of help you out and get you started. Ruben is asking, should I buy a property that is local or in a different market? Great question. So I'm in Philadelphia, outside Philadelphia. I buy product in Texas, North Carolina, South Carolina. I obviously live here in Pennsylvania. So it really depends on your business strategy or investment strategy. I know here in Philadelphia, based on those cap rates, it could be a 4 to 6 cap versus if I go to Texas, South Carolina, I could buy that same product at an 8 cap or 9 cap, and that's just because of lower cost of living, taxes, things like that. So again, it comes back to your comfort level. If you can get started in your local market, that's great. I encourage that. But if not, then you may want to consider investing in markets outside where you live currently. So looking at the um, question box, I think we're good to go. Um, was this helpful? I mean, is there anything else you think we need to talk about? Just let me know. Yeah, okay, great. Thank you, Verna. Appreciate your comment. Helpful, thank you. Very helpful, thank you, Marcel. Um, all right, well, listen, if down the road I can be a resource to you, need somebody just to talk about a deal. I'll be happy to help you out if I can. And if there's, excuse me, if there's not any more uh, questions, okay, Marcel, you have a deal in North Carolina. All right, Charlotte. I like Charlotte. Send me an email and see what we can do to put a deal together. That would be great. So I'll just give. Thanks, Philip. Appreciate that. All right, I'll just give you one more minute, guys, and then we'll wrap it up. And I wish you all a wonderful Tuesday. And if we don't speak, which we probably won't, but also a wonderful Thanksgiving next week. And if you could, if I could get your vote for the Helping Homeless Veterans, I would so appreciate it. And if you happen to know anybody else that you could share that link to, again, I would appreciate it so much. Let's help out our veterans, get them into home ownership. All right, guys. Will you? I think we're in good shape. And thank you so much. And enjoy the rest of your day. Take care.